The rich often keep their investment strategies a secret, but the key to forming a successful portfolio is diversification. This means spreading out investments across different asset classes, such as stocks, bonds, real estate, and commodities, to minimize risk and maximize returns. Additionally, it's important to regularly review and adjust the portfolio as market conditions change and personal financial goals evolve. The rich also typically have access to exclusive investment opportunities and seek the advice of professional financial advisors. How to build a strong investment portfolio.
Right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be. Corporate profits have grown about 7 or 8% a year. That means they double, including dividends, about every 10 years, quadruple every 20, go up 8-fold every 40. That's the kind of numbers you're interested in. Then a 10-year bond today is a little over 2%. So I think the stock market's the best place to be for the next 10, 20, 30 years. The next 2 years, no idea. I've never known what the next 2 years are going to bring.
Have a long-term outlook. Investing with a long-term perspective, rather than trying to time the market, can lead to better returns and reduce stress.
Diversification to improve your return to risk ratio.
Diversify globally. Diversifying investments across different countries and industries can provide exposure to a wider range of economic conditions and opportunities. Consider alternative investments. Consider allocating a portion of your portfolio to alternative investments such as private equity, real estate, and commodities, to potentially increase returns and diversify risk. Rebalance regularly. Regularly rebalancing your portfolio to maintain your desired asset allocation can help ensure that your investments stay aligned with your financial goals. Seek professional advice. Working with a financial advisor who has expertise and resources can provide valuable insights and help navigate market changes and make informed investment decisions. Consider tax implications. It's important to consider the tax consequences of investments and choose those that align with your overall tax strategy. Invest in what you know. Investing in companies or industries that you understand can help you make more informed investment decisions.
Huge run. I mean, the market was 4,000 just, 2.5 years ago. Yeah. And it ran up to 8,300 in August. And, like any big rally, sometimes it backs off. I mean, it's healthy. In fact, I'd rather have gone down 1,000 points than gone to 12,000. If you look at Japan, Japan went from 5,000 to 15,000 on their Dow. And it was fairly priced at 15,000 on earnings and everything else. Then it went to 40,000. And that caused 7 years of inflated real estate, people overspending, and basically they've been in a recession for 5 or 6 years because their market went up too high. The market goes too high, you're discounting earnings 7, 8, 10 years out.
Avoid chasing returns. It's tempting to invest in the latest hot stock or trend, but these investments often come with higher risk and may not provide sustainable returns in the long run. Monitor your portfolio regularly. Regularly monitoring your investments and adjusting your portfolio as needed can help you stay on track towards your financial goals. Have a plan for emergencies. Having an emergency fund in place and planning for unexpected events, such as job loss or medical expenses, can help protect your portfolio and provide peace of mind. Don't put all your eggs in one basket. Avoid investing too heavily in any one stock or industry, as this can lead to increased risk and volatility.
The fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. When stocks are down, we're going to be buying on balance. And who wouldn't rather buy at a lower price than a higher price? People are really strange on that. I mean, because most people, most of your listeners are savers. And that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. And they got that feeling that they just feel better when stocks are going up.
Stay disciplined. Stick to your investment plan, even during market downturns or times of uncertainty, to avoid making impulsive decisions based on emotions. Be aware of fees. High fees and expenses can eat into your returns, so it's important to choose investments with low fees and minimize unnecessary expenses.
Stocks sell at silly prices from time to time. It doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act. You should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things, because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or an apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
Keep emotions in check. Avoid making investment decisions based on fear or greed, and instead focus on your long-term financial goals and strategy.
Many years ago that it's an invisible tax that only one man in a million really understands. The best investment against inflation is to improve your own earning power. The best passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting, in the United States, the value of the dollar since I was born has declined by 94% to 6 cents. But things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world. But actually, it's worked out pretty well, so I have no complaints.
Don't forget about inflation. Inflation can erode the purchasing power of your money over time, so it's important to consider investments that have the potential to provide returns that keep pace with inflation. Remember, investing can be a complex and time-consuming process, but taking a thoughtful and disciplined approach can lead to long-term financial success. Thanks for watching. If you're looking for a reliable and user-friendly platform for trading and investing, I highly recommend Interactive Brokers. Click the link in the description to sign up now and start your journey in the financial market. Remember, as an affiliate, I may earn a commission if you decide to use Interactive Brokers through my link. Thank you for your support.